Another type of activity that's very important to stockholders is when a spin-off occurs. So if we think back for a second, mergers and acquisitions, that means somebody's buying or merging with another company. A spin-off is the opposite of that. A spin-off was where you have a company, typically a larger company, and they're spinning off or selling off or creating a new division, or essentially not a new division, but a whole new company, right? And so it becomes two companies. In some cases, maybe even more than that, but usually it's two companies. So you have the one big company, and they spin off apart, and now you have maybe the big company is a little bit smaller, and you have the small other company, and you have two companies, two new companies. Though two companies, they're not necessarily new, there may be existing brands and all that, but they essentially trade differently on the stock exchange. The spin-off now becomes its own company, and you can buy shares in that spin-off specifically just with the spin-off without having to buy it part of the overall company. And that's the idea behind spin-offs, is looking at a couple things. And one is if you spin off a company, you might have something that's really good, but you think it could run much better and be more focused as its own company. Think of like a big conglomerate that might have, like General Electric, that has they're into banking, and they're into engines, and they're into software, and they're into consulting, and all this stuff, right? Well, maybe certain companies in there might be better if they split them off and let them run as their own company, and they were a completely separate company. So companies will split off apart if they want to have more focus, both in the parent company, the one who is the original company, and the child or the spun off company, to allow them more focus for both parent and child. Also, you can see better stock valuations, is the idea of better stock valuations, because now that they're separated, investors can invest in either company more to what they're interested in, more to their liking. Sometimes when it's one big company, people are buying that stock because it's got this one little arm to it that they like, but there's also competitors out there that might do the thing the one little part does. And they would rather if the company split up, and then people will like the big company will buy, and then people like this new small arm that could grow, they can invest in that, especially if they're almost acting like two different type of companies anyway. So they're looking for better stock valuation for both the parent and the child, as opposed to one big entity. So an example of that, a really good example of that, is Altria, probably pronounced that wrong, but Altria was the parent company that owned a lot of different brands, and one of the brands it owned, two of the brands it owns was Philip Morris and Kraft Foods. So Philip Morris, you might have heard their name, they're famous for cigarettes. Philip Morris makes cigarettes. I think they're the leading supplier of cigarettes in the world. I believe they make Marlboro. I don't smoke, so I'm not the expert on cigarettes, but they make cigarettes, and they're the big player in cigarettes. Kraft Foods makes food, different types of foods, essentially particularly known for like cheeses and things that they sell in grocery stores, cheese and markets. So if you like your macaroni and cheese, you might like Kraft macaroni and cheese. If you like cigarettes, you might like Philip Morris, Marlboro cigarettes. The thing is, they're very different, right? If you think about it, if cigarettes versus food. If I want to invest in a cigarette company that might pay a high dividend, well, then I'll invest in a cigarette company. If I want to invest in a food company, I don't want to mess with cigarettes and all that. I want to invest just in a food company. So when they're together, it makes it more troubling to invest in. And particularly, and this is a good example too, where the parent company and the founding of the company was on cigarettes, and is known for cigarettes. That's why they changed their name from Philip Morris, that owned Kraft, to Altria, to change that up a little bit. Because there's lots of people that say, I would love to own Kraft Foods. I think it's a good stock. I think it's a good market. The grocery, the consumables, the consumer package type goods, all those things. I think it's a good market. But I don't want to invest in a cigarette company. I hate cigarettes. I don't want to invest in a cigarette company. And cigarette companies have all these regulations and things I'm just not want to get involved in. I don't want to just invest in the food company. Why can't Philip Morris split off Kraft Foods so I could just invest in Kraft Foods? And that's really what happened. That's what drove it. Is there's so many shareholders saying you need to split these two companies up, because on their own they could be a great performing cigarette company or a great performing food company, but together they actually drag each other down. So they spun off Kraft, and now you can buy Kraft as its own stock, and the Philip Morris, or actually Altria, continues on, and you can buy a cigarette company through that. So are spin-offs good for investors? That's what we really care about. It's like, okay, I understand the business sense behind it. All right, now, is this good for us as investors? Well, the idea, and what studies show, is for both the parent and the child, it's good in the long run. In the long run, it's actually good for both companies to become more focused, and then people can invest in both of those. And but there is some short-term pressure on the spin-off. When investors get something spun off, they get shares in that new company, let's say Kraft, and they still have their shares in existing amount, as they split it up in Altria. And at that point, they might not want one of those. So if we spun off Kraft, and I really like Kraft, and I got some shares in Kraft, well, I might sell the rest of my Altria shares, my Philip Morris or my cigarette shares, and buy more Kraft or buy something else. So that can exert some downward pressure on either side as they get split up, depending what people like and as they move between the two or move completely out of the stock. So they can have some short-term, poor pressure on there. Long-term good, typically, but short-term pressure. Also, the person that's spun off, the company that's spun off, may not pay a dividend like the parent company did. The parent company might be really established, well-known, hundreds of years, who knows, and been paying a long-term dividend, but when they spin off the smaller company, that may or may not pay a dividend, which can then also exert short-term pressure, in this case, on the spinoff. If I bought the big company because I like the dividend, now a portion of my shares is in the big company, but a portion now went to the small company, I'll sell that small company and buy the rest back into the big company so I can get back to my dividend. So that could be, that could be impactful too. And when they spin off too, they're not in an index a lot of times. Now Kraft might be because it's such a big company, from a big company, Altria, but a lot of times when you might be a big company in the index and the S&P 500 or a large company index, and when they spin off another part, well, that other part might not qualify to be in the index. So what happens to its shares? Its shares go down because people, companies that are investing, or mutual funds that is, or exchange trade funds that are buying an index, once that spinoff happens, they get rid of that. They get some shares of that spinoff, but are like, hey, you're not in the S&P 500 index. We're an S&P 500 index fund. We have to buy those stocks, so we're going to sell you, and we'll buy back into the big company. So you have some short-term pressure there too. But the long term, the studies show good. I mean, there's been lots of studies around spin-offs, and long term, it does allow for the management teams in these separate companies to really focus on their business and what they do best. They can get rewarded with like stock options and things to focus on that part of the business as opposed to being tied in with all sorts of other things. And you do also start getting new investor money in too. So we talked about the downward pressure which happens, but now you also get new investors that come in too. Altria, once again, is such a good example. Like, maybe somebody would say, I'd never buy Altria. I love Kraft, but I'm never going to buy anything because I hate cigarettes. Well, once they split off Kraft, they're like, wow, I can buy Kraft now by itself, and I think the long-term prospects is good for that. Well, here's my money. Here's some new investment coming in that will help drive Kraft, and same might help Philip Morris by being more focused too, or Altria. So as you can see, spin-offs are more than just a management type thing. They're all about management and how to be efficiently managing scarce resources, effectively managing separated companies. But as investors, when a spin-off happens, you really got to start making decisions on what you want to buy and sell. And do you want to have your shares split with that spin-off and keep those portions? Or do you want to buy or sell one or the other to, balance your portfolio or make different decisions? So when spin-offs happen, look closely at the information they send you from the company. They'll talk about in the information how much of the existing company shares you'll keep, how many shares in the new company you get, in the value and the price for all that. And then from there, you need to make decisions as far as now they're two separate companies. So treat them as two separate companies and treat them as two separate investments in your overall portfolio.